Federal Reserve kicking off its two-day meeting on interest rates tomorrow. I want to take a closer look at the markets right now with Ed Yardeni, Yardeni Research President. Good morning to you, sir.
Thank you.
We're all trying to figure out where this is all headed. I think we're at a quarter point, but I don't know. Some people are now suggesting maybe we get, half a point.
It's a stretch. It's possible, but I'm like everybody else in the quarter point camp. I've actually been in the camp that said, hey, I don't know if we even need that because the economy is doing quite well. Labor market's been weak, but the GDP numbers are strong. So could it be that productivity is actually making a pretty nice comeback? If it is, that would explain the kind of discrepancy between...
Is that an AI comeback, AI story? What is that to you?
It could be partly AI, but I think what really has motivated the productivity surge, I think, is the shortage of labor, particularly skilled labor. And companies, that's why, initial claims, at least until last week, remained very, very low. And I think layoffs are going to remain very low because companies are holding on to their workers and trying to augment their productivity.
Right. In terms of the equity markets right now, baked into the cake already is a quarter point.
Yeah.
So after that happens, let's say that happens, does the market go up on the back of that news because it's confirmatory, or does it say, we were actually hoping for more?
Yeah, well, I think the market's hoping for 25 and would be pleasantly surprised by 50 basis points. But 50 basis points really would create a melt-up situation in the market where I think you'd see the market going up too quickly on valuation. Right now, valuation isn't cheap. We've got a 22 times forward PE. This has really been an earnings-led bull market. We took that dive. Remember, the last recession was during the pandemic and only lasted 2 months. And then it took us a few months to recover. And since that point where we recovered what we lost, we're up 100% on the S&P 500, and forward earnings are up 100%. So it's been a surprisingly robust earnings environment, especially this year in the face of tariffs, DOGE, and all the other policy uncertainties.
And so when you think, though, about the unevenness of this market, you've talked about earnings. Yes, 22 P of 22 on a forward-looking basis.
Not cheap.
But not cheap.
No.
But super uneven, meaning there's some companies that are pulling those numbers in crazy ways.
Yeah. Well, you're right. I mean, the Magnificent Seven are about over 30 times forward earnings. And then what I call the impressive 493, I think they have been impressive, and we'll get even more so. I think, those multiples are around 19, which isn't dirt cheap, but it's certainly fairer value than what we're seeing in the Magnificent Seven. But the Magnificent Seven have demonstrated over and over again that something that we haven't seen, I think, ever in the past, where large companies just grow double-digit earnings. I
want to just go with this idea of just how strong the economy is, because you're saying you believe it's actually very strong, to the point where I think you might not even cut a quarter point.
Exactly. I mean, I kind of see a similarity between now and what happened last year. Last year, the Fed lowered interest rates by 100 basis points from September to December, and the bond yield went up 100 basis points because it turned out the economy wasn't all that weak and inflation wasn't at 2% yet. It was still elevated around 3%.
So do you think that the reason they'd be doing this is just because of the political pressure? What's your thought here?
Well, I think it's the political pressure, but they also have, obviously, an excuse here. I mean, they are data dependent, and they don't necessarily agree with my interpretation of the labor market. The labor market data has been weak. There's been a downward revision, but I don't think the GDP numbers are going to get revised, so I think the productivity numbers are going to get revised up. If we've got now productivity-led economic growth, then interest rates are basically where they should be. If they lower them, then the risk is that you get a melt-up in the stock market, and then you get a meltdown.
So you look at things completely apolitically.
I try to.
Yeah, I've never seen any bias in the things that you lay out on this. What do you think of everything that has been layered on this politically, and how do you sort through it?
Well, I've been doing this for a few years, and one of my mantras that I've learned over the years is it's truly amazing how well the U.S. economy and the U.S. stock market have done despite Washington. Everybody's bias is to see the headlines, to look at fiscal monetary policy, all the politics. And my attitude is, wait a second, look at all the rest of us, all of us working stiffs that are doing an amazingly great job of running companies, running our businesses, working. And despite the
What do you think about where the markets are right now? You had the S&P 500 hit an all-time high during the trading session intraday. You have the NASDAQ close at a new high.
Well, since 2020, I've been talking about the roaring 2020s, and so far so good.
Does that mean you think we've got another 4 years to go or so?
I got the market over 10,000 by the end of the decade. So yeah, and then I started talking about the roaring 2030s. I mean, the 1920s ended badly because of tariffs. And this time around, we're kind of stress testing the global economy with a tariff issue now. And we got stock markets around the world at record highs despite that. That didn't happen in the early 30s. And so I think the resilience of the global economy, the U.S. economy, earnings, companies being able to use productivity, technology to increase their earnings, all that adds up to a bull market that continues.
Does it not matter what the Fed does, or does it help even more if the Fed cuts rates heading into what you are?
Well, I think it matters in the sense that if I think we're at neutral. I mean, the unemployment rate is 4.3%. The inflation rate is basically around 3%, still about a percentage point higher than the 2%. So we're kind of there. You know, when the kids in the back say, "Are we there yet?" Well, we're kind of there in terms of the right level of interest rates, in my opinion. If the Fed continues to cut here, then the risk is that the valuation multiple starts to lead the market up instead of earnings. And melt-ups are followed by meltdowns.
First article I saw this morning, I didn't read it, but it was, and I don't want to say where it was because I look at a lot of different sources, but it was, look for the S&P to suffer its biggest weekly decline since April after the Fed cuts.
I doubt it.
That's the sell on the news.
Yeah. I kind of
people have to write articles.
Yeah.
You know.
I'll tell you why I doubt it, because I think the real surprise this year has been the resilience of the economy.
Nothing has hurt it.
And earnings.
Market or the economy.
Yeah. Earnings were much better in the first quarter than expected, much better than expected in the second quarter. And I think we have to take, it goes to the adage here, is like, look how well our companies are doing despite the turmoil of
it's not
policy
just turmoil,
making.
but how are they eating the tariffs? That's the thing. And we had Gary Cohn on who said that they're laying off people.
Yeah, they're
not hiring people.
I just actually wrote it up. Part of the answer is it looks as though Chinese companies are actually cutting their prices in an effort to offset. So they're eating some of it.
That's good.
Companies are offsetting some of it with productivity, and consumers are taking the hit and some consumer durable goods.